Good evening, everyone. This is Kerry Given. I'm the founder of Parkwood Capital, and I coach students on stock and options trading. And Dr. Singh and I have gotten together to develop a special course just for his clients that cover all of the various option trading strategies that he uses in his services. And so this course tonight, this is just going to be a brief tutorial that we're going to focus on selling put spreads. Now this is very brief, but this just gives you a sample of the kind of coaching that we're going to have in the full course, where we will cover each of these strategies of Dr. Singh in much more detail. An option spread is created by buying one option and then selling another. Now if the option I sell is more expensive than the option I buy, I end up with cash coming into my account, and we call this a credit spread. If, on the other hand, the option I buy is more expensive, then actually I end up with a net outflow of cash, and we call that a debit spread. Now, we can build spreads in a lot of different ways. We can use calls or put options. We can use different strike prices or the same strike prices, or different expirations or the same expiration. Now, the vertical spreads that we're going to talk about that Dr. Singh uses are formed with two put options, one bought and one sold, but they're in the same expiration period. Now, we call these vertical spreads because of a historical accident, I guess you'd say. If you go back many years when the Chicago Board Options Exchange was first formed, the option prices were on a board on the wall, and across the top were the different expiration months, and down the left-hand side were the different strike prices. And so when someone created a spread that was in the same vertical column, in other words, in the same expiration month, that was called a vertical spread. And so that's where that term comes from. If we sell a put option at one strike price and then move down a strike and buy that put option, we've created a vertical put spread that's bullish. In other words, that spread will achieve its maximum profit if the underlying stock closes at expiration at a stock price that's above that strike price that we sold. And so that's how we collect our profit. Here's an example with Apple trading at $156 a share on the 25th of October of this year. We could go out and sell that November 150 put for $1.95 and turn around and buy the November 145 put for 89 cents. And so we have a net credit of $1.06, or if we traded one contract in each of these, we'd have $106 for that spread. We received $106 in our account. And so if we traded 10 of them, we'd have $1,060. And you can see how that works. Now, if Apple closes above 150 at November expiration, which is November 17th, then both put options will expire worthless, and we'll just keep that credit of $106 that we collected initially. But there are several different ways to position our put spread that go from more aggressive to much more conservative. The example I just gave you with Apple at 156 and selling the 145-150 put spread yielded $106. Now, the probability of success, if you calculate the probability using standard deviation and so forth, you will find that the probability of Apple closing above 150 is 72%. So that's a pretty moderate, pretty good probability and a pretty good return. Now, if I want more return, if I'm much more aggressive, then I might sell the put just above the stock price. With Apple at 156, I might sell the 160, buy 155. Now that yields $283, much higher return. Because again, if both those options expire worthless, meaning Apple is above 160 at expiration, then I will keep the $283. But it's a lower probability of success. There's only a 41% probability of success for that trade. Now, Dr. Singh prefers much more conservative approaches to the options trades. And in this case, he'll use the put spread, and his choice will be more like this third example, where he would sell the put down pretty low, like at 140, with Apple at 156. So he's down well below the current stock price, and then buy the 135 put. That yields a credit of $21 per spread. Now that is a fairly modest return. It's not huge, but it has a high probability. In this case, for this example, that was a 92% probability of success. And that's why he likes this approach. Here are several trades, put spread trades, that Dr. Singh recommended on October 7th of this year. And I've put them in this table. On the far left, I have the stock ticker symbols, what the price was at that time, and the expiration. They're all using the weekly option that expires on October 13th. This is the put spread in each case. In other words, the first one is the strike price that we buy. So for a WZC, we are buying the October 13th 77 put and selling the October 13th 78 put. We return a credit of $2, and this is the break even for this trade, just below the strike that we sold, 77.98. If this gets our full profit, our return on investment is 2%. And as you can see, the trades go from about 2% up to about 21%. And this is one of the unique things that Dr. Singh does. In his trade alerts, he lists what he calls his ultra-conservative recommendations, and then his conservative recommendations, and then his more aggressive recommendations. And that's what we're seeing here as these returns get higher. But notice in every case where the break-even is, even in this, the most aggressive trade here, the stock is trading $88. It has to trade down to $82 or just above $82 before you lose money on this trade. So in all these cases, the break-even is well below where your current stock price is. So that's why these are all very high probability trades. And that's why Dr. Singh selects them and structures them the way he does. So in summary, Dr. Singh's trading strategies are innovative. In fact, some of the more advanced strategies are quite innovative. I had never seen anything quite like them before. But he is always very conservative. And this is only one strategy of several that Dr. Singh sends out to his students. Our coaching course will cover each of these strategies in more detail and also help you with order entry and how to actually use your broker's website to place these trades. I hope I get to see you at our next course on Dr. Singh's option trading strategies. Until then, you are now leaving the no hype zone. Take care out there. Good day.